Welcome to the deep dive. I mean, imagine you're obsessively inspecting this massive, complex highway bridge for structural cracks every single day.
Right, just checking it over and over.
Exactly, but you're completely unaware that, all the heavy 18-wheeler cargo traffic has secretly diverted into an unmapped, unregulated underground tunnel.
Which is pretty much exactly what's happening right now with the global financial system.
Yeah, it really is, because today, $2 trillion of that system has basically gone underground. We are looking at the explosive rise of private credit.
And it is a massive shift.
It's huge, and we've got a really fascinating stack of sources for you today. We're looking at a fresh Reuters news briefing from today, Monday, March 30th in 2026.
Yep, fresh off the press.
Plus, we've got these deep analytical reports from the Federal Reserve, the Bank of Japan, the Office of the Comptroller of the Currency, and some incredibly detailed asset management notes.
There's a lot to unpack here.
There is. Because the mission for this deep dive isn't just to, report the daily financial news.
Right, we want to look at the actual structure.
Exactly. We're going to peel back the layers of how the global financial system is quietly shifting right under our feet, moving from this highly visible banking system to a parallel, almost invisible credit operating system.
A completely different way of moving money around.
Yeah. So to start us off, looking at the headlines this morning, the Fed says it's not systemic, right?
That may be true, but it depends on what you're looking at.
And that tension right there is exactly why we're doing this deep dive. Because on the surface, the narrative we are being handed today is, well, it's incredibly reassuring.
It sounds totally fine on paper.
It does. Let me give you a quick recap of what the mainstream view is right now, just based on today's Reuters briefing.
Yeah.
So Fed Chair Jerome Powell was just speaking at Harvard.
Right.
And he explicitly stated that while the Federal Reserve is closely monitoring the private credit sector, they currently see absolutely no signs of a systemic crisis.
No red flags for cascading bank failures.
Exactly. He said the policy is in a, quote, good position, even with the recent Middle East supply shocks and the energy price spikes we've been seeing.
And, to be fair to the chairman, that view is factually accurate based on traditional metrics.
Right, if you look at the usual dashboards.
Exactly. U.S. banks are well capitalized right now. They've been rigorously stress tested over the last decade.
Ever since 2008.
Yep. So the traditional banking system is holding up fine despite high interest rates and geopolitical tensions. The mainstream narrative correctly identifies that within the visible banking grid, the risks currently look local and manageable.
So no dominoes falling.
Right. If you were looking strictly at bank balance sheets, you aren't seeing a systemic crisis.
Okay, let's unpack this. Because if the visible grid is stable, my intuition, and probably the intuition of anyone listening who follows the markets, is that we should be fine.
Sure, that's the logical leap.
But given everything we know about how risk mutates, the fact that they're primarily looking at the visible grid is exactly what's concerning.
It's the whole bridge and tunnel analogy you mentioned earlier.
Yeah. We all know 2008 taught us that everything is connected. Connection risk is the ghost that haunts the Fed, right? If Bank A fails, does it drag down Bank B?
Right, that's their primary focus. The Fed is watching connections.
Isn't that what matters?
What if the system is being replaced instead?
Oh, wow. Replaced, entirely.
Essentially, yes. Michael Hsu, the acting controller of the currency, gave this very sobering speech recently where he warned of a great blurring between banking and commerce.
A great blurring? That sounds ominous.
It is. He pointed out that leading up to the panic of 1907, again before the great crash of 1929, regulators were watching the traditional banks perfectly well.
But they missed something huge.
They completely missed the fact that the actual risk had migrated into new, unregulated entities. In 1907, it was the New York trust companies.
Ah, right. I remember reading about that. They were acting like banks but weren't regulated like them.
Exactly. They were doing bank-like activities without bank-like capital buffers. And today, it's non-bank financial institutions. The system isn't just expanding. The core macroeconomic function of lending is shifting outside of traditional banks.
I was actually looking at that Boston Fed report, and it completely reframes how I view banking now.
It's eye-opening, isn't it?
It really is. We're not just seeing banks lend less, we're seeing the entire function of lending get outsourced. The report notes that private credit in the U.S. grew from about $46 billion in the year 2000 to roughly $1 trillion recently.
And globally, it's hitting $2 trillion.
$2 trillion. That is a massive underground tunnel. It seems like entities known as business development companies, or BDCs, are taking over the credit expansion.
Yes, BDCs are a huge part of this shift.
But mechanically, how are these BDCs actually functioning differently from, say, the regular bank down the street?
Well, it really comes down to where the money originates. A BDC is basically a closed-end investment fund. It pools money to lend specifically to small and mid-sized companies.
Okay, so they're making business loans.
Right. But unlike a traditional bank, which uses federally insured customer deposits to make loans, and is therefore heavily regulated and scrutinized, a BDC raises capital directly from investors.
What kind of investors? Like you and me?
More like pension funds, endowments, wealthy individuals. And because they aren't using traditional retail deposits, they operate completely outside the strict regulatory perimeter of a commercial bank.
But the banks aren't entirely removed from this ecosystem, are they?
Not at all.
Because according to the Federal Reserve Board's data, as of late 2024, large U.S. banks had about $95 billion in committed credit lines to these private funds.
Exactly. So the banks aren't making the loans to the businesses directly anymore.
They are just providing the liquidity pipelines for the non-banks to do it.
Precisely. They are the wholesalers, and the private credit funds are the retailers.
That's wild. So the bank is essentially funding the underground tunnel.
Yes. And what's fascinating here is the structural distance that creates. Let's say a bank extends a massive credit line to a BDC.
Okay, got it.
The BDC then turns around and lends that money to, say, 50 different highly leveraged tech and manufacturing startups.
So very risky loans.
Very risky.
Mm-hmm.
But the bank isn't underwriting those 50 startups. They're only looking at the creditworthiness of the BDC itself.
Oh, I see. So the actual on-the-ground risk of whether those 50 businesses survive or fail is pushed one step further into the shadows.
Exactly. The bank just sees a solid fund. They don't see the fragile startups underneath.
So going back to our analogy, we are obsessively checking the structural integrity of the main highway bridge, completely ignoring that all the heavy cargo traffic has secretly diverted to this uninspected tunnel.
That's exactly what's happening.
But wait, if all this heavy financial traffic is moving through that underground tunnel, wouldn't we still feel the tremors if there was a pileup?
You would think so.
Because normally, if a sector is struggling, bond yields spike or stock prices drop. Markets would react if something was wrong.
Only if there's a price.
Wait, what do you mean only if there's a price?
Well, markets can only sound the alarm if they have a public price tag to look at.
Mm-hmm.
And with private credit, that public price simply doesn't exist. It operates entirely in the unpriced domain.
Because it's private.
Exactly.
Yeah.
Private credit is, by definition, private. It is illiquid. When an investor puts money into a private equity or private credit fund, that capital is often locked up for 5 to 7 years.
7 years where you can't touch your money.
Right. And during that time, there is no daily stock ticker for these specific bespoke private loans. They aren't traded on a public exchange where buyers and sellers constantly negotiate their value.
So how do they even know what the loan is worth?
They are valued internally by the funds themselves.
They grade their own homework, which means the risk is completely silent.
It is entirely silent until it's too late. And the mechanics of how these loans are structured, well, it actively keeps the volume turned off.
How so?
Federal Reserve Governor Cook actually highlighted this in a recent warning. She brought up a practice in private credit called PI, payment in kind.
Payment in kind. That sounds suspiciously polite for a financial term.
It does, doesn't it?
If I had to deduce what that means in an unpriced domain, does it mean the borrower just stops paying cash and the lender agrees to just tack the missed interest onto the principal of the loan?
That is exactly what it means.
We're kids.
No, it's essentially a feature where a struggling company says to the lender, hey, I can't afford to pay the interest on this loan right now. Let's just add the interest I owe onto the total balance of the loan and deal with it at maturity.
And the lender just agrees to that.
Yeah. The private credit fund, wanting to avoid marking down a loss on their books, says, sure, we'll just add it to the tab.
Okay, here's where it gets really interesting. Because in a traditional bank loan, if a company stops paying cash interest, alarms go off immediately. Right?
Immediately.
Huh?
The bank has to classify it as a non-performing loan. Regulators see it. The market sees it.
But in this private credit operating system, the use of payment in kind just kicks the can down the road.
It kicks it way down the road.
So the default rate looks incredibly low on paper, even if the underlying company is basically insolvent and just burning through cash.
Precisely. It artificially masks defaults. And we are absolutely starting to see the delayed consequences of this.
Right. The asset management notes we looked at mentioned some specific recent events from late 2025 and early 2026.
Yes, like what happened with Blue Owl Capital.
They are a massive, highly respected player in this space.
Huge. And they recently halted redemptions on a retail private credit fund, meaning investors tried to take their money out and the fund essentially locked the doors.
Wow. And that's not the only one. We've also seen actual bankruptcies of private credit-backed firms recently, like the auto parts supplier First Brands Group and that UK lender Market Financial Solutions.
Exactly. What stands out about those specific events is that there was no gradual decline.
Right. You didn't see a stock price bleeding out over 6 months warning you of danger.
No warning at all. You just woke up one morning and the company was bankrupt, or the fund had frozen your money.
It's just a sudden drop off a cliff because the alarm bells were disconnected the whole time.
Which brings us to a really counterintuitive point. Because of this dynamic, the broader system may not break suddenly.
Isn't that good? I mean, I prefer things not breaking suddenly. A sudden break sounds like 2008. We want to avoid a massive financial heart attack.
We do. But it might decay slowly instead.
Decay slowly. That doesn't sound great either.
It's not. And we have to ask ourselves, which is worse for long-term prosperity? You see, private credit fundamentally alters the physics of financial time.
Altering financial time. What do you mean by that?
Let's think about a traditional banking crisis. A shock hits the system, say housing prices collapse or interest rates spike.
Okay, standard panic scenario.
Right. Because bank loans and public securities are heavily scrutinized and marked to market every single day, prices drop immediately. Panic sets in. There's an immediate, violent crash.
A heart attack.
Yes.
Yeah.
It's incredibly painful. But it forces the system to clear out the bad debt. Unviable companies go bankrupt. Assets are sold at a massive discount to new buyers. And eventually, the system resets and economic growth returns.
So the Band-Aid just gets ripped off.
Exactly. But the private credit operating system operates completely differently. Because they don't have to mark their loans to public market prices every day. And because they have investor capital locked up for 7 years, a macroeconomic shock doesn't lead to a panic.
It leads to what we talked about earlier.
Right. It leads to extend and pretend.
Extend the loan and pretend everything is totally fine, like those payment-in-kind loans.
Exactly.
I was actually reading that Liberty Street economics study. That's the research arm of the New York Fed, right?
Yes, highly respected research group.
And the scope of it is staggering. They mapped this out across 33 different countries over several decades, and they found this profound divergence between how bank credit and non-bank credit affect the economy.
If we connect this to the bigger picture, that Liberty Street study is basically the Rosetta Stone for understanding our current economy.
It really is. They found that when you have a massive boom in traditional bank credit, it is a strong statistical predictor of extreme sudden drops in real GDP down the line, a traditional crash.
Right. The boom leads to the bust.
But when you have a boom in non-bank credit, like the private credit boom we are living through literally right now, it actually lowers the probability of an immediate, sharp GDP drop.
So on paper, it looks like a massive win.
Yeah. It looks like the rise of private credit is actively preventing recessions.
It prevents the sudden crash, yes.
Yeah.
But what the study also meticulously points out is the long-term invisible drag.
The slow decay.
Exactly. Because these funds are masking losses and trapping capital in underperforming companies, that money isn't being efficiently deployed into new, innovative businesses.
Economists call these zombie companies, right?
Yes, zombie companies. And it's incredibly telling that the Bank of Japan recently released a review noting this exact dynamic.
Well, the Bank of Japan definitely knows a thing or two about zombie companies. That was the entire story of their lost decades after the 1989 crash.
They lived through it. Banks just kept rolling over bad loans to practically dead companies so they wouldn't have to admit they lost the money.
And now the BOJ is looking at the global private equity and private debt funds, and they are essentially saying, hey, we've seen this movie before.
That's exactly what they're saying. They pointed out that these funds have heavy investments in companies that are suffocating under massive interest burdens.
The companies aren't defaulting, but they aren't growing either.
Right. To put a concrete visual on this, imagine a mid-sized software company that was bought out by private equity.
Okay, pretty common scenario.
Today, It makes just enough money to pay the interest on its PIK loan, but absolutely nothing more.
So it's just treading water?
Barely.
Yeah.
Can't hire new developers. It can't research new AI tools. It can't innovate. It's essentially a financial zombie walking around technically alive on paper, but sucking up capital and market share that should be going to the next hungry, innovative tech startup.
Wow. That is the precise reality of the slow decay.
And the policy of high interest rates might actually be exacerbating this exact dynamic right now.
Because with high rates, the cost to extend and pretend goes up significantly.
Exactly. The debt burden on that software company just gets heavier and heavier.
But because it's all happening in the unpriced domain, the policymakers at the Fed look at their dashboards, they see that the visible banks are stable and the public markets aren't panicking, and they conclude that policy is in a good position.
Right, which goes back to Powell's speech at Harvard today. The better the policy succeeds at preventing a sudden banking crisis, the longer this silent degradation of credit quality is allowed to continue in the shadows.
So what does this all mean? So not a crisis, but not fine either.
Maybe something that doesn't show up as a crisis?
Because we avoid the sudden heart attack, but we get a chronic wasting disease instead.
It is not about whether risk exists or not. The risk absolutely exists. It's about the separation of observable risk and unobservable risk.
The bridge versus the tunnel.
Exactly. The traditional visible banking system has been completely de-risked over the last 15 years.
That risk didn't just evaporate.
No, it simply migrated into the non-bank private credit system.
So the crisis isn't not happening, it is progressing entirely off the observation grid.
Yes. And because it's off the grid, we aren't going to get the satisfying, dramatic climax of a Lehman Brothers collapse.
We are just going to get stagnation, a gradual, imperceptible lowering of the ceiling on what the global economy can actually achieve.
Where would the first signal appear?
That's the billion-dollar question, isn't it? If the risk is silent and the decay is slow, how will we know when the pressure in that underground tunnel finally gets too high?
Because the liquidity has to come from somewhere, eventually.
Right. Remember those $95 billion in bank credit lines we talked about?
The pipelines from the banks to the funds.
Yeah. If a massive wave of private credit loans starts to sour and those funds simultaneously draw down their bank credit lines to cover their obligations, suddenly the invisible risk becomes very visible on bank balance sheets.
And while the Fed currently assesses the banks are well capitalized enough to absorb that specific shock today, as the private credit market continues to balloon well past $2 trillion.
That math gets significantly more complicated.
It really does. It forces you to reconsider every headline you read about the economy. When top officials say the system is stable, you really have to ask which system.
The one we can see or the one we can't?
Is this a crisis or something else entirely?
It's a really unsettling thought.
I want to leave you to ponder a few things as we wrap up this analysis, because the discomfort here is the point. We shouldn't jump to conclusions, but we must ask the right questions.
Absolutely.
Will the first signal be in the business development companies when their leverage finally catches up to them? Or maybe in the insurance sector? Or is this just a new, lower growth normal that we have to accept?
And perhaps the most vital question of all for everyone listening. When we talk about $2 trillion locked up in these illiquid, unpriced funds, whose money is that?
That is the most important question.
Because it's pension funds, it's life insurance companies,
Oh,
which
yeah.
means the ultimate bag holder in this invisible system isn't just some Wall Street bank.
It might just be your retirement account.
Exactly. If a wave of silent defaults finally hits the wall, how insulated is your 401k from a market that doesn't even have a public price ticker?
Something to think about.
Definitely. Thank you for joining us on this deep dive. We've gone from the reassurance of traditional banking stability right into the murky, unpriced tunnels of the $2 trillion private credit boom.
There's a different world down there.
It really is. Keep a close eye on those quiet corners of the financial world because clearly that is where the real traffic is flowing.
Yeah.
The next time you hear that the structural integrity of the main bridge is sound, remember to ask what's happening in the tunnel underneath.